Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So today we're going to talk about how to use a little bit of smoothing and some signal filters to improve performance. And this is mostly for a trend following type approach. We're going to first look at the close versus the 200-day and compare that when we smooth that with a 5 versus a 200-day to see how those signals differ. And then we're going to add a little filter to that 5-200 cross. And we're going to do these examples with the S&P 500. But I think it's important that you remember that you can take these techniques and apply them elsewhere to, say, other moving average combinations, or even to, say, a MACD signal by looking for a filter for it to get above or below a certain level on a cross. And then we're going to take it a step further and we're going to quantify results using the S&P 500 and see if we really improve results by going from just the close 200 cross to the 5-200 cross with a filter. So here's a chart for the S&P 500, and the red line is the 200-day moving average. And then below, I've got the percentage difference between the close and the 200-day moving average. And this indicator is part of the TIP Indicator Edge plugin. You can go down to the bottom right and you see the plugin icon. And if you click on that, you can see all the plugins available for StockCharts ACP. Now, about this plugin, if you go over to the top left, you can see the settings. And this is basically percent above MA indicator. And I'm going to click on the settings icon there. And you can see got 1 day for the fast moving average, 200 for the slow. I don't have any signal periods, 1. And we'll use the upper reference and lower reference later on, as well as change that to a 5 as we look at some signals. But this is just a very basic generic cross above and below the 200-day moving average. And you can see we get a lot of crosses. There were a lot of crosses there in March. We had that breakdown in late February, and then in March some crosses. And then we had some crosses there in the first and second quarter of 2020. We had a long uptrend into 2021. And then we got a bunch of crosses in the first quarter of 2022, and some crosses here in November, December 2022. And so the 1-200 cross is an important cross, but you can see there are way too many whipsaws, and we need to smooth these out. And we're going to do this with a 2-step process. First, we're going to put a 5-day moving average on and see if we can do that. But before we do that, I want to show you a technique to filter out some of these signals just with the raw closed 200-day cross. And that would be by adding a 5% filter to your signal. So if I put that upper reference at 5 and the lower reference at -5, then we'll see that we have a line to filter signals. So we wouldn't take a 5-200 cross unless we moved more than 5% above the 200-day. So if we look here, we can see that we get this signal in early March. So there's going to be some delay when you add that filter, but we did get a signal to avoid part of this crash here at the COVID crash. And then we got a bull signal there in June. It was lagging, but it was still timely because this signal lasted a long time, because you can see we didn't have a move below 5% until late February 2022. And that signal has stuck because you can see we're avoiding all these whipsaws by applying that 5% filter. Now, I chose 5% just to make sure that these two signals didn't result in whipsaws. The level that you pick is a bit subjective. The higher it is, say 10%, you're going to get more lag. But if you keep it too short at say 1%, you're going to get more whipsaws. So 5% is kind of a good a good compromise, if you will. So that's how that reduces signals. So another way to reduce whipsaws would be to change the close into a 5-day moving average. And the thick green line on the price chart is the 5-day moving average. And that will cut down on a lot of whipsaws because you'll get fewer crosses of the 200-day than, say, using a close above and below the 200-day. So in the indicator window, I've changed that to 5201. So this is a 5 crossing above and below the 200-day. And you can see we did get a cross there in early March, a little bit earlier than the 5% threshold. And then we got a cross here in late May. And we got some whipsaws in January, February, and in March, April. But we've been bearish ever since. So you can see the 5-day has been below the 200-day since the middle part of April. And on the price chart, you can see that that is the case. And so that is another way to smooth out those signals, because I think the 200-day moving average and the S&P 500, it's a powerful combination. The S&P 500 is, of course, the most widely used benchmark for U.S. stocks, the most widely followed benchmark. And then the 200-day is the most used moving average. But still, if you don't smooth out that little signal line, like close with a 5-day moving average or something, you're going to get a lot of whipsaws because there's a battle around the 200-day moving average. And so in the next step, we're going to add a 1% filter to this 5-200 cross. So here we are with the 1% filters. And if you go to the upper left, I will open up the indicator settings. And there you can see the indicator and the settings. We got the 5-day and the 200-day. We're not using a signal period. The upper line is at 1%, the lower is at minus 1%. So we can see the moves above and below that level to filter out the signals. And so when we put a filter on it, the signals are going to be a little bit later. So we did get a signal in early March still, the 9th of March, when we were 2.5% below. The 5-day was 2.5% below the 200-day. And then we got a bullish signal there in early June, late May actually, when the 5-day was 1% above the 200-day. And then we still got the whipsaws here. You're not going to totally eliminate whipsaws. That is just impossible. They're going to happen. The idea is that a few good trends are going to pay for those whipsaws. And so I'm going to take this cursor off. But you can see here, look at this amazing trend that you got from late May until January. That is a big uptrend that's going to pay for some whipsaws. And there you can see the whipsaws on the price chart there. And now we've caught a good downtrend. Good. Is a downtrend good? Well, you did catch a downtrend. And you can see it came up to the 200-day and turned down. We've come up to the 200-day and now there's a big battle raging for the 200-day. Will we fail or will we break above? And right now the 5-day is below the 200-day. And if you look at the indicator window, you can see we need to get above that 1% threshold to get that 5-day cross above the 200-day to say it is a robust cross. It has met the filter requirement. And the chances of whipsaw are less because your signal to reverse that would be a move below minus 1%. That doesn't mean you're not going to get whipsaws, but the chance of whipsaw is reduced. And so this is a real battle zone to watch in the coming days and weeks for the S&P 500. Now, again, if you're interested in this indicator and others, check out the Trend Investor Pro Indicator Edge plugin. And if I go over to the top left, I can open up the indicator settings and scroll to the bottom. And there are 11 indicators here. We've got an ATR trailing stop. We also have the momentum composite to look for overbought and oversold levels, as well as the trend composite, which is at the bottom there. And that aggregates trend signals in 5 different indicators. And you can read more about it by clicking on that plugin link and then clicking on the actual plugin there on the pullout, on the call out that comes there. There is a video that explains how they work, as well as a detailed article. So we never get a true idea of how a signal works unless we put some numbers behind the actual signals that we see. And to do that, we need to run some sort of a back test. And so I'm using Amy Broker software here to run some simple back tests. This first one is just the close above and below the 200-day. You buy when it closes above, you sell when it closes below. And we're going to run that from 1/1/2000, January 2000, until December 2022, actually the 13th of December close. And so if we look at these signals on the price chart, you can see this is just since 2000, with the red arrows showing across below and the green arrows showing across above. And we can see there have been lots of signals, especially in that first part of 2022. And then you look at the bottom window, that's the actual cross above and below the 200-day. And we saw that chart on StockCharts ACP. So let's see how those numbers look. So let's look at the backtest numbers here. First, we've got buy and hold just kind of for reference. And if you just bought the S&P 500 on January 1st, 2000 and held it until December 13th, you'd have a compound annual return of 4.5%, which is okay. It's not great. But you see the largest drawdowns, the 5 largest drawdowns, 37% is the average of the 5 largest drawdowns. And that's because you had big drawdowns in 2002. After the dot-com bubble burst, you had a big drawdown with the global financial crisis in 2008. And we also had a 33% drawdown with the COVID crash. And there were a couple of other double-digit drawdowns along the way. And the drawdown is basically the biggest decline from a portfolio peak to a portfolio trough. And so that is basically how much pain you're going through to get that compound annual return of 4.5%. So if we just apply a close above and below the 200-day moving average as a signal, we would have had 87 trades. So there's a lot of trading going on there. 21 winners, 66 losers, win percent 24%. That's not very good. A quarter of your trades are winning. 75% are losing because you're getting a lot of whipsaws. Average gain 9.65, average loss 1.43. That's okay, but still too many losses and a low win rate. And then the compound annual return is less than buy and hold, 3.79%. But, and this is the benefit of using these kind of indicators, the drawdown is seriously reduced. It's just below 20%. And so you're going through a lot less pain. But we can improve that by adding that 5% filter. So let's look at that next. So here I just ran the back test, and we're only buying when the close is 5% above the 200-day or more, and then selling when the close is 5% or more below. And you can see we have a lot fewer trades already. And we will look at these signals, and we can see that there are a lot fewer signals. And they're going to be a little bit later. But there you can see on the histogram at the bottom, when you go below 5% below the 200-day, it turns red. And then when you go 5% above, it turns green. And so we had a signal there in early June that lasted a long time. And we had a signal there in late February 2022. So we're currently in a downtrend. And this indicator wouldn't signal until we get 5% above the 200-day. But let's put some numbers to this and see how it looks. So I'm going to scroll down and look at the next test. So here we have the test we saw before, and look at that. We went from 87 trades to just 8. I mean, that's pretty crazy over the last 22 years. You had 6 wins, 2 losses, 75% win rate, average gain 27%, 27.8, average loss 4.7. Compound annual return, a lot higher, 5.88%. And the largest drawdown was even smaller, 16.1%. So you can see that this helps a lot by just adding that 5% filter for your signals. So now we're going to move from a percentage price filter to a smoothing of the close. So in the previous example, we wanted the close to be 5% above the 200-day for a bull signal, or 5% below the 200-day. That's a filter. Now, instead of using that filter, we're going to use a 5-day moving average, smoothing that close to cross above and below the 200-day moving average. And I put the signals here so you can see them. The green line is the 5-day, and the dark red brown line is the 200-day. And you can see you're going to be a little bit late, but you're going to miss out on the COVID crash, most of it. And you're going to miss out on most of the rebound, but you're going to get in about where you got off. And you say, well, that's no big deal. Well, you say that when you're long in the middle of the COVID crash. Better to be on the sidelines at this stage and getting back in here, because look at this trend you would have caught. Now, the upside is catching big trends, but the downside of a trend following model is whipsaws. And that's what we've seen in 2022. We've seen a lot of whipsaws because the 5-day moved above and below the 200-day 4 times already. Now, the move that we had in April is sticking so far, and the 5-day remains below the 200-day. So we're still in a downtrend according to this indicator. And the bottom window shows the histogram, which also shows the crosses of the 5-day and the 200-day. So now let's look at the Excel table that I put together. So we had 32 trades, 5-day crossing above the 200-day, that's like 64 crosses. 14 winners, 18 losers, still below 50%, but a much higher win rate than say the close above and below the 200-day, 44% win rate. Average gain, average loss, very strong. And the average gain is smaller because you're getting shorter signals instead of these 20+% average gains like we had before with the 5% threshold on the closed 200-day cross. We've got a smaller average gain because we're getting more signals. But the compound annual return, 5.58%, that's strong. And the average drawdown was 16%. That is tolerable. So now we're going to use a little smoothing and a price filter to see how the results would be affected. So basically, with the closed 200-day cross, we're using a 5% filter. But now we're going to use a 1% filter. And that's because we're smoothing the close with a 5-day moving average. So we can have a smaller or tighter filter, if you will. So when the 5-day crosses above the 200-day by 1% or more, that's a bull signal. And when the 5-day crosses below the 200-day by 1% or more, that is a bear signal. And you can see there's lots fewer signals when we add that 1% filter versus what we had before. And then we look on the price chart, we can see these signals. We're still going to get whipsaws. And you can see there are the same number of signals basically since 2020. We had the COVID crash and we got out before the actual crash and we got in after the rebound in early July. And then we had the whipsaws in the first quarter and into early April of 2022. But you can't look at a back test just going back to 2020. We need to go back 2 market cycles at least, and I'm going back to 2000. So let's look at the results when we apply that 1% filter. So you can see we went from 32 trades to 19, fewer trades. We had 13 winners and 6 losers, and the win percent was 68%. So we had a higher win rate. And you can see you got the average gain a little less, the average loss a little less, but that's still very good. Compound annual return was 5.5%, and the average of the 5 largest drawdowns, 15.6%. So these systems are relatively equal, but you have to give it to the 1% filter because of the higher win rate and the fewer whipsaws. That's what we want. Fewer whipsaws and higher win rates will make it easier to trade your system. So now let's look at these strategies and see how they compare against each other. Now I'm going to go over to the right first, and we'll look at the compound annual return and the average of the 5 largest drawdowns. And you can see that the 5 200 cross, which is the white line there, the closed 200 cross with a 5% filter, which is the middle line, and then the 5 200 cross with the 1% filter is the lower line. These are all roughly the same. 5.51 to 5.88% compound annual return, drawdowns in the 16% area on average over the last 22 years. So there's nothing really differentiating here. As far as the differentiating factors, you've got 2 things. First, you have the number of trades. All right, if you look at the closed 200 with the 5% filter, you just had 8 trades, not very active. So if you don't want to be active, this is the strategy for you. If you just want to wait until there's a clear close above the 200-day that's 5% or more, you're not going to trade very often. If you want a little more action, you're going to go to the 5 200 cross with the 1% filter, 19 trades. And the 5 200 cross has 32 trades, which is the most active of the 3. But all 3 have a lot fewer trades than just the closed 200 cross. And then the next thing is the win rate. And if you look at the 5-200 cross, it has a 44% win rate. So it's got the lowest win rate of the group. The closed 200 cross with the 5% filter has the highest win rate, 75%, but the fewest trades. And then you look at the 5-200 cross with the 1% filter, you're getting that high win rate. And this seems to be a bit of a sweet spot here. The 200-day cross with the 1% filter, because you got 19 trades. It's not the lowest number of trades and not the highest. It's a relatively few number of trades with a good win rate, and you're still getting the same returns with the lower drawdowns, if you will, because the average drawdown was 5.59%. So I think this is a pretty good combination to consider. And also keep in mind that this is a technique that you can apply to a moving average and apply it to another stock or an ETF, not just the S&P 500. Now, longer term moving averages like the 200-day, those systems tend to work better with large caps because small caps are a little bit more erratic. But the point is you can apply this technique of using a smoothing mechanism, the close to a 5-day moving average, and a filter, a 1% filter, a 5% filter, to make sure those signals are valid and you're not going to get whipsaws. And I think that's going to help you with your trading down the road. So here I am at Trend Investor Pro, and I want to show you two things on the website. First, I've got a market regime page, and that is where I use the composite breadth model to determine if we're in a bull market or a bear market. And we had a bull signal at the end of November. And then the second thing I want to show you is the trend momentum bull bear ETF strategy update. So here is the market regime page, and I update the composite breadth model every week and put out a notification if something changes during the week. That first indicator window shows the model. It was bearish from the 11th of April till the 30th of November. And you can see we got the whipsaws at the beginning of the year there. We're currently at +1, which means 3 of the inputs are bullish and 2 are bearish. So as long as it's +1, that means the weight of the evidence still favors the bulls right now. A little bit lower down, you can see we have the percentage of S&P 500 stocks above the 200-day, 61.43% or above. And so that means more than half are above the 200-day, not well more than half, but a good portion. Instead of 51%, it's 61%. So that tells you that the weight of the evidence is still bullish, even though we do have pockets of weakness in the market right now. It's not like a runaway bull market like we had in 2021. Now, the other thing is the trend momentum bull bear ETF strategy. And this is an 11-part series. The first 9 parts broke down the strategy and showed how it worked with the indicators. It basically trades the all-weather ETF list, and it uses the composite breadth model to determine the bull market or bear market environment. And what it does is it trades the stock-based ETFs when you're in a bull market environment. Actually, it trades any ETF when you're in a bull market environment. But when you go to a bear market environment, it does not trade these stock-based ETFs. Instead, it trades the alternatives, which are bonds, metals, commodities, and currencies. And so it's 14 equal weight positions, and there are 50 ETFs to choose from. And I go through this model and explain how it works. It uses the trend composite to identify a trend. It uses Stoke close to rank the ETF as far as trend strength. And so it looks for uptrends and it buys the ETF with the highest Stoke close value. And this is an example with MDY because it was added to the hypothetical portfolio on December 1st when the composite breadth model turned bullish. Now, this is a systematic approach. I also have a ranking table so you can follow the signals and the rankings for 274 ETFs, as well as the all-weather ETF. And this is an example for silver. It was added to the portfolio on November 10th. And as you can see here, the composite breadth model was bearish, but silver is an alternative ETF. So when the trend composite turned bullish, it was added to the hypothetical portfolio. I also go over portfolio performance and set the benchmarks. Now I'm going to scroll down through these numbers, but there's how the portfolio has has performed since 2007. The red arrows show the bear markets, and you can see it had a good run here, but we're currently in a drawdown. There is a drawdown going on because 2022 was a very rough year. But if you look at this portfolio, you can see that it performed quite well from 2018. It was moving higher when the market was just all over the place. The blue line is the equity curve for the S&P 500, and this is the equity curve for the portfolio. So here we see the drawdown, and I quantified that drawdown. You can see it's 16.46%. You know, previously the drawdown stopped short in that 12 to 14% range, but 2022 has been a very rough year, as I said. So we've got the biggest drawdown since the strategy was back tested in 2007. Now, I also did a month by month and year by year breakdown, and you can see I had 3 good years, 2019, 20, and 21, and now we have a bad year. And the market giveth and the market taketh. We can't expect every year to be a roaring uptrend. But you can see we've had 3 good years. So you've had 3 big steps higher, actually, 21%, 17.8%. So we're giving some back, and that's normal. And the trends will come back. Nobody knows when, but this strategy is designed to catch those trends and do the momentum strategy when it does work. So we're currently down 11.7%. But these things happen because the market, as I said, is always full of surprises, and it's never a straight line higher. There are going to be drawdowns. So if you'd like to know more about this strategy, check out trendinvestorpro.com. Note that next year, I'm going to be introducing 2 new strategies. I'm going to be introducing a mean reversion strategy for ETFs and a momentum rotation strategy for ETFs. So stay tuned for that. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.